are saying this has been an environment where you can find maybe an increasing number of distressed opportunities. How do you see it? How do you, especially the last month amid the volatility and uncertainty?
Carol, for us, we were really busy last year. And last year with these hot equity markets, you would not expect us to be busy, right?
Yeah.
So we were really busy last year, and if anything, the pipeline for us, it has really turbocharged over the last couple of months. Would it help if I described even the setup from last year?
Yeah. Well, can I tell you something? I went and got my notes from our conversation last year. You said the world economy will be a bog next year, meaning this year. You believe that we're going to wake up 18 months from now, whether we've had a full-blown recession or soft landing, it's just a slog. Low GDP growth, higher rates, maturity wall, and higher defaults. And you also talked about the opportunity in Europe. So hands down, because you called it, I was like blown away. So go ahead. Pull out your crystal ball and tell me where we go next.
Thank you for the advertisement.
Well, it's the truth. It's the truth.
But you know, what happened last year was, we have, you know, if you're a private equity fund manager, you ran into COVID, then you ran into the Fed raising rates, and now you've run into a whole new administration with a whole new set of policies. So you've not been able to realize, you've not been able to monetize at the pace you wanted to. And if you're a private equity manager, you do these amend and extends. You were starting to talk about that earlier, and the total amount of debt keeps climbing. Every time you do an A&E, the debt on it gets bigger and bigger. The debt has to pay higher interest rates. So even last year, in that strong economy, you had 5% default rates. Now, what's happened in 2025, look, we don't know if you're going to get a recession or not in the United States. Don't know. The US economy is extraordinarily resilient. It can take a lot, right? But clearly you have a slowdown. Clearly you have higher rates. And that 5% default rate, our view, recession or no recession, you've got multi-years now where we are going to be restructuring and working through these historical portfolios.
Can you give us an example, though, of kind of what's the cushion? Like, oh, so at 5% now, I mean, if that goes up 2 or 3 percentage points, does that mean some of these companies are basically, they're just not going to have the cash flow to service that, or is it a wider gap?
The real issue with a lot of these is, you know, Romaine, what I was talking about, the total debt continuing to climb. Mm-hmm. So if you raised $1 billion of debt to do a leverage buyout, when short-term interest rates were 0, now that $1 billion of debt with the A&Es has become 1.2 and 1.3 billion, and the 0% is 4% risk-free. You're really paying more like 8 or 9 or 10%. Ooh, you've got a problem. It's really, it's just that.
So you're trying to capitalize. Can you quantify, I mean, how much money have you really put behind this in terms of chasing new opportunities as you're starting to see some of these companies struggle, for lack of a better phrase?
You know, the first thing, all of us have portfolios, Romaine, right? The first thing when you see a sea change like this, it is a sea change, you ask yourself, hey, how good is my portfolio? Do I have it really battened down, right, at a moment in time like that? And then we have a good portfolio.
Okay, all right.
The second
noted.
Thing, right,
we'll put that at the bottom.
Right. The second thing you do.
Was that to your investors?
The second thing you do is you say, okay, how good is the opportunity? So for somebody like us, look, we've got about $22 billion in AUM.
Right.
We invested $4.5 billion in new investments last year. And we monetized, we realized $5.5 billion.
Is that going to be higher in 2025?
The investment dollars, the first 3-4 months, we've been much slower. We're waiting for this market to these prices to correct even more. But I do think over the next 3 years now, you're going to see a higher investing pace from us than the $4.5 billion a year.
One thing Victor, I wanted to ask you is the amend and extend. Is there a point, though, that there's going to be some shakeout and some mini crises, if you will, in terms of some of those firms that just kept getting pushed down, renegotiated, that ultimately they're going to go?
When you say the crisis, you mean for the company which does the amend and extend?
No, well, their exposure, right?
Yeah,
to some extent, I feel like there's a couple different ways you can play it. I'm curious how that plays out, or does it get managed okay?
Carol, when I say a 5% default rate last year, that means 1 out of every 20 companies in high yield leverage loans defaulted last year, 1 out of 20. In an average portfolio, private equity portfolio, our view, there are another 3 or 4 companies in that 20 company portfolio which are really struggling with these high rates and the maturities, right? So it's a pretty gnarly, messy kind of situation where we are.
Those companies, and I am curious, how involved are you? I'm talking about companies that you are currently invested in. How involved are you in counseling them through turmoil, through uncertainty about tariffs and the economy and et cetera?
Romaine, we do a lot more than counseling. Look, so 40...
Exorcism is what you're talking about?
What is it?
When you're in, 40% of our portfolio goes into deals where we will end up with owning the majority, having operating control. And when we have operating control of a business, we're really looking, and it's been struggling with debt. It's got a business which is underinvested. For us, we are strengthening the management team. We are investing money behind the business. Yes, there's some cost cutting, but we are really focused on putting that good business back together. So our engagement, we have a large team of operating partners. We are really engaged with the management team and driving that change.
Hey, listen, 15 seconds, Europe, yes or no? Lots of opportunities right now.
Lots and lots.
Really? Okay.